Morning, Richard.
Hi, how are you?
I'm very well. How are you?
Good, good. Yeah, thanks for joining us today.
Good.
So as we normally do with our guests, it'd be good for you just to, and I know you've provided a few slides, just to introduce the fund, and then we'll go into questions. So I'll hand over to you.
Thank you. Well, I'll start by introducing myself. So I'm Henry Butt. I am the assistant portfolio manager for AWU. I work alongside Laura Elkin, who's the portfolio manager. Laura is currently off on maternity leave and will be back with us in February. So I'm in the hot seat for the time being, stepping in as interim portfolio manager, caretaker manager, so to speak. So you've got me rather than Laura this morning. So then moving on to AWU, this first slide is a snapshot of what we're trying to do. High income and actively managed. That is a very important brief sentence, which in a nutshell is what we're doing. We are looking to typically buy higher yielding properties with net initial yields in excess of 7%, but typically we would be looking to buy things starting with an 8% net initial yield with reversionary potential, so looking to capture rental growth. And we are capturing that rental growth through asset management, hence the second part of this brief sentence being actively managed. And we really like to get under the bonnet of our assets and engage with tenants and look to add value and grow the income of our properties through that asset management process. And when we are buying assets, we very much buy them with a value investment hat on. And by that, what we mean is that we are not typically buying assets with very long leases in alternative sectors. We are really looking at the underlying bricks and mortar value of those assets, as long as there is income on top of that. And that has meant that we are typically buying properties which yield the right income on day one, but they also have the flexibility to take into other alternative uses and to add value through asset management. And that really kind of feeds into these two metrics in this light blue box on the left-hand side of this slide. So in terms of maximizing income, we have now paid out our quarterly dividend of 2p per quarter for 35 consecutive quarters. This presentation is as at March. We released our Q1 NAV actually yesterday, so that's now 35 consecutive quarters. And as of March this year, we have an annualized 8.9% 5-year total property return. So that is the metric which is really sort of illustrating the property returns that we're getting from the asset management, obviously collecting this higher income. And we are outperforming the benchmark that we compete against by 6.8%. And I think what enables us to really perform as strongly as this is that we are unconstrained by sector. So we are sector agnostic. So by that, a sort of common theme at the moment is a lot of investors are quite twitchy and don't feel very confident in the office sector, for example. So we'll be selling out of that sector. Conversely, investors will be investing into the industrial sector, which has performed very well over the past couple of years, especially in the post-COVID era. We don't follow the herd, and we look at properties on a case-by-case basis, which touches on what I've already said, is that we will look at each property and look at its property fundamentals, its location. We will break back the value on a cap val per square foot. We will look at the tenants, the asset management opportunities, and we will compare what that asset is on day one and what it is as kind of a plan A in relation to what plan B might be, whether that be getting vacant possession and selling to an owner occupier or moving into an alternative use, for example, residential or student or life sciences, which we did on an office a couple of years back. So just moving on to this investment criteria, much of which I've already touched on, is actually the same slide. And apologies, Richard. Just touching on a few of these, we typically buy UK core plus commercial property, strong commercial locations with low levels of supply, net initial yields, as I said, 7 to 10%. And then these next two bullet points are quite important to us. Low book values of £72 a square foot. Now that is the £72 a square foot is the existing portfolio. Now, why that metric is really important is because if you compare that alongside what it would cost to build properties, i.e., it would cost you in excess of £100 a square foot to build retail warehousing or to build an industrial unit. It would cost you in excess of £200 a square foot to build offices or residential or a hotel. So the existing portfolio, relatively speaking, has an average book value of £72 a square foot, and it's yielding a net initial yield of 8% on top. So, that means our portfolio is fantastically positioned. We've got all this income, but on top of what is a relatively low cap value per square foot. And the metric below that as well, low passing rents, so average in the portfolio of £6.46. I mean, if you compare that, let's say, to an office building in the city, which is £100 a square foot, or prime logistics, which are kind of as high as £10 a square foot now. These are low rents. I mean, I think it's fair to say that it's brought down by a high weighting in industrials. We have 37% in industrials. But that low average passing rent really does sort of signify the reversionary potential within the portfolio, and that you'll see that penultimate bullet point here says that we've got a reversion potential in the portfolio of 8.8%. And just to finish, obviously, we're delighted that we have been recognised for this property performance and NAV performance with these raft awards at the bottom. I think we've won the Citywire Award now 4 years on the trot, which is based on 3-year NAV total returns. Right, so we can move on to the next slide. So this is a snapshot slide of what we do, a 30,000 feet view of the portfolio, a valuation of 210.7 million. This is as of March. That valuation was up this quarter by 2.4%. 33 properties, now 32. We sold a multi-let industrial estate in Droitwich at a 33% premium to the March valuation this quarter. And then net initial yield just shy of 8%. So that is the income that we are receiving from the existing portfolio, with reversion of 8.77. So that is what, as asset managers, we are going after. We are trying to capture that rental uplift. And then the next two metrics here, a vacancy rate of 6.3. We don't mind having vacancy. It's thought of as being a negative thing, but actually having vacancy, a little bit of churn in your portfolio is a good thing. It allows you to do refurbishment. It allows you to improve the capital values of your properties. It allows you to bring in better tenants and move on rent. So not necessarily a bad thing. And the WALT, which is the weighted average unexpired lease term, 4.3 years to break and 5.6 to expire. We like this. It's shorter than what you might typically find. It gives us the ability to engage with our tenants, and lease events are seen as an opportunity rather than a risk to the company, because it allows us, as I say, to move on rents, extend lease terms, etc., etc. In terms of the debt, we like to blow our trumpet here. We've got a £60 million debt facility. We locked this in at 2.96%, and we've got that rate until May 27. We're very fortunate at AEW that we have an in-house debt team who have their finger very much on the pulse with regards to the debt markets, and they recommended to us that we refinance a year ahead of our previous facility with RBSI expiring. We did that, and we locked in a new 5-year term with AgFe at 2.96%, which is obviously very favourably positioned with what's going on elsewhere in the market. With regards to our NAV, a NAV of 162.75 million, breaking back to 102.7 pence per share as at March. Our NAV total return for the June period was up 5.04, so that's moved on since. And our share price has been trading around 90 pence, which is around a sort of 16% discount, but that is based on 86. That discount has moved in more recently, but is trading around 90 pence. In terms of property performance, I've touched on this, but the most important metric here is 8.9%, 3 and 5 year property total return. We are specialist asset managers, so we're delighted by those figures, and obviously that feeds into the 5-year annualized NAV total return of 8.6. And then just to finish, these two pie charts on the right-hand side, the most important one really here is the sector split. We're 37% in industrial and 37% in retail, which is split into retail warehousing and high street retail. It's probably important to say that this is very much organic. We don't ever say we'd like to increase our exposure to a certain sector. It is what it is based on the opportunities that we see in the market and when we buy them. Move on to the next slide. So yeah, this is a pretty important slide to us. There's obviously been a lot of chat about earnings and dividend cover, and this is our sort of journey to sort of moving our cover and earnings back to the 2 pence per quarter. We had a period at sort of 18 months, 2 years ago, where we sold out some quite chunky properties, and we had about £40 million worth of disposals, and those disposals were in assets where we had actually quite high vacancy because we had to take them to high vacancy to achieve the asset management goal, which was essentially selling them as alternative uses. So we sold an office park in Oxford to a life sciences buyer and an office in Glasgow to a student developer. But what the general theme really has been over the course of the past 2 years is selling out of lower yielding assets, whether those be vacant possession ones, because there's an alternative use play on the table, or lower yielding industrial assets, and reinvesting that money into high yielding assets. So as an example, we sold an industrial unit in Milton Keynes for a 6.3% net initial yield. We sold an industrial unit in Deeside to an owner occupier, which was vacant, and we sold 2 industrial buildings in Yorkshire for a blended net initial yield of 6.2%. So we're selling things essentially which are either vacant or yielding low sixes, and we're reinvesting that into properties like we've bought 2 properties in Bath off an 8.5% net initial yield and 8%. We bought a multi-story car park in York off a net initial yield of 9.3. So we are selling out of things in the low sixes and we're reinvesting that into things north of 8%, which has helped us build our earnings over the past year plus. So move on to the next slide. So this just looks at our dividend cover, 91% dividend cover since inception. We like to sort of emphasize the total return theme of AEW. As I say, we are asset managers, and therefore, obviously earnings and income is very important, but we obviously like to add value, and we obviously have a track record of selling out of properties and crystallizing significant profits, and we are able to top up our dividend with those profits, which nicely moves me on to the next slide, which kind of illustrates this. So we've got a 38% average sale to purchase price premium on all the assets we've sold since fruition. I mentioned earlier that we actually sold an industrial estate at 33% above the March valuation in this quarter just reported. But just touching on a few of these, if you look at the bar, which is the Oxford, which sticks out like a sore thumb, just an example, we bought this for 8.2 million, yielding is 9.4%, and we ended up selling it for 29 million, so a significant profit. And that was the asset management taking it from a more bog standard office use into a life sciences and medical use. Rather than actually carrying out refurbishments, we decided to sell this one because there was a huge weight of money chasing the sector at the time. Looking at the property we sold in Corby, we bought that for 12.4, net initial yield of 10%. So you can see, giving us the income, we sold it for 18.8 to an owner occupier. The office in Solihull, we bought that for 5.4, off a net initial yield of 11%, and sold that for 10.5. So we are basically buying properties which are high yielding. We are asset managing them and selling them off lower yields and crystallizing some significant asset management profits, which have enabled us to top up our dividend as and when we want to. Move on to the next slide. This is a very strong slide. It's probably my favorite because it really shows our performance in comparison to our peer group in terms of our total return. And it's even more pleasing to see that more recently our return is moving further apart from our peers. But I think the most important thing to sort of say here is you can see that our performance really starts to sort of break away from the peer group in June 2019. Now, I mentioned earlier on us having a shorter weighted average unexpired lease term to break an expiry. So therefore, it's not surprising that our performance moves away after about 4 years, because we're typically buying properties which have lease events 4 years in. So that is where we can obviously, I guess it's say, engage with tenants and add value. So it's not surprising that that's when our performance starts to move away, because we are doing the asset management. I think it's probably also worth noting that we have a 37% weighting to industrial. We did have a higher weighting to industrial back in June 19, and obviously that sector performed very well at this point in time, set against the backdrop of COVID and the growth of e-retailing and logistics. But yeah, a 5-year annualized NAV total return of 8.6, which we're very proud about, and we hope that theme will continue going forward. So this next slide, apologies, it's a bit of a sort of jumble of lots of reds and greens, but just to sort of summarize it, we have the highest share price total return of our peers over 5 years, the second highest over 3 years share price total return. But actually moving to the box on the right-hand side, you will see that we have the highest NAV total return for 5, 3, and 1 years. So we are, obviously very proud to have that really strong performance against these peers here. We have a very strong dividend. We are aware that obviously our investors are very keen on our dividend. It's probably worth noting the regionals dividend here obviously sticks out like a sore thumb, but note that they are obviously trading at a very, very heavy discount. We are at 9.3. This is as at March. Obviously our share price has improved a bit there, so that yield has hardened a little bit, but a very strong yield, and something that we are obviously proud about. In terms of our property return, Zane, I don't want to sound like a broken record, but 8.9% over 3 and 5 years, which is 6.2% outperformance against the benchmark. I think this is a very strong graph, 9.1% as of 7 years. And obviously, we're moving towards a 10-year track record. So yeah, this just shows our property performance in comparison to the benchmark, which, as you can see, is significantly stronger. And then this slide just breaks down that slide on a sector by sector basis. As you can see, strong outperformance. It's worth noting. You can see the income return is quite significant here. I think it really does sort of show how important rent is, obviously, as a property investment. That so often people can get everyone's looking at adding value and what they can buy a property for and what can sell it for, but the income obviously is the lifeblood of what we do in the property sector, and especially for this strategy. So I've got a few slides here which just sort of show just a few sort of asset management things that we have been working on. If you kind of follow our NAV announcements and our investor meet company presentations, you're probably sick to death of hearing us talk about Central 6 and Coventry. But this is a property which really kind of illustrates what we do as asset managers. We bought this property for £16.4 million a couple of years ago, and it had 24% vacancy. And since we have bought it, we have now got it fully let. We have bought in Aldi and Iceland, so a wider variety of uses. And we've grown the income by just shy of about £500,000. So I think that really sort of portrays what we're trying to do at AWU. A lot of asset management. It was actually sold by an institution who didn't really have the appetite to do this asset management on what is probably a smaller lot size for a larger institution. We were very happy to sort of get under the bonnet, hit the ground running here, and let up these units. And I think it really kind of touches on retail warehousing as a sector. We like retail warehousing because it's kind of well located in peripheral urban edges. If this was to fail as an investment, you could probably flatten it and move it into a residential site, or you could convert these purpose-built units into last mile logistics or trade counter. And this property has, fared really well. There was a relaxing of the planning use class system, which enabled landlords to bring in a wider variety of tenants, and it very much kind of feeds into the whole derived demand theme, whereby if the footfall increases, you get a wider variety of tenants, rents increase, and that all kind of feeds into investment performance. So a property that we've, as I said, been very busy on over the last 2 years, and glad to have it now fully let. This is a property that we hold in Rotherham. The reason why I like talking about this property is because not only does it show the reversionary potential, we moved on the rent here by about 50% when the unit fell vacant, which again, we say we don't mind it when tenants vacate, because it gives us the ability to move rents on and bring in new tenants. But what I like about this property, other than obviously pushing on the rent and enhancing the value, is that when we did this letting, we spent money on the roof, and by doing that we improved the environmental performance of the asset. And people talk to us about ESG and EPCs and minimum energy efficient standards. I think given that we have a shorter weighted average unexpired lease term, it means that we can engage with tenants, and when we do these lease events, we have the ability to improve the environmental performance of our assets. And this is a classic example of that. Had this property been let for 15 years, we wouldn't have had the ability to do that, but we got it back, we moved on the rent, we enhanced the value, we got in a good tenant, and we improved the environmental performance. So everything that we're looking really to do. So yeah, to conclude, we are happy with our earnings. We continue to move them on in the right direction. And I encourage you all to see our most recent NAV announcement, which came out yesterday. It's probably worth noting that our earnings were 2.26 for the quarter, which were enhanced by the billing of 3 years of turnover rent at one of our leisure parks in Dagenham, and a reversal of some service charge costs. But so the underlying earnings were about 1.92, but still moving in the right direction as far as our earnings are concerned. We've got some really exciting asset management in the existing portfolio, and we've got some good cash to enable us to do some asset management, and that is currently the focus rather than buying new properties. There is significant reversion potential in the portfolio of 8.8% in comparison to the net initial yield of 8%. And obviously that's why we are holding this cash, to try and capture that reversionary potential. We're also, despite there being great opportunities, we're aware that it is a bit of a sort of sticky wicket out there in terms of the occupational markets to a certain extent. There have been CVAs, and therefore, we're aware of that, and that's why it's good to have a bit of cash in the event that you do have issues with tenants. But as I say, we don't necessarily see that as a bad thing. We had Wilco as one of our tenants in Bristol who went to administration, and actually we are in the process of reletting that unit to 2 new leisure tenants. So that's a classic example of making the best out of a bad situation. And to use that metric again, low book values of £72 a square foot and low passing rent of £6.46, because there's relatively low. There's a lot to go after, which we're very buoyed about. Our values are underwritten against long-term fundamentals. So in the event Plan A doesn't sort of play out, you can look to VP values and alternative use values as a good sort of bedrock to an investment. We're proud, obviously, of our track record of crystallizing gains on sales, a 38% average purchase price, a sale to purchase price premium, and we've got that low cost of debt fixed until May 27, which obviously bodes very well for what we're doing. So thank you.
Cool. Great. Thanks, Henry. Right, there's loads of questions come in. So kick off. I'll try and group some of these so we're not sort of darting all over the place. So first of all, perhaps we start with more portfolio specific questions. So are you happy with the sector weightings at the moment? And supplementary question, what subsectors are you looking to add to and reduce, if any?
Well, as I said, we are sector agnostic, and it's very organic. So it's not like we are specifically setting out our stall to reduce or increase sector weightings. I think, when I was talking about earnings, there was this sort of bit of a common theme that we were selling out of lower yielding assets, and those typically tend to be in the industrial space. And it's probably worth noting that our industrial weighting has fallen over the past sort of 18 months from about 60% to about 40, just shy of 40%. So, that shows that we have been selling out of lower yielding industrials. But there are still good opportunities out there in the industrial sector. I mean, I think it's very obvious that the heaviest mispricing at the moment is in the office sector. So there's some potentially exciting opportunities to go after there, because we say we're value investors. There's going to be a lot of value in offices at the moment. However, I'm aware that not only sort of is the office sector suffering because of kind of the post-COVID era, where people are less keen to go into the office and people are working from home more, but also we've obviously been through a period of hyperinflation, and the cost of refurbishing offices has just gone through the roof. And there's the ESG pressures of offices now as well. So I'm a little bit twitchy about taking on offices where there would be quite heavy capex. But as I say, I think in general, I think the sector weighting will probably stay quite similar. I mean, in terms of, as I say, buying opportunities, I would say that they probably are in the sort of larger blocks of mixed use retail, high street retail offices in good cities. We bought a couple of assets in Bath, and we bought a next in Bromley. So those types of properties. So I think that the weighting in retail might actually go up a bit, and I think that the weighting industrial might come down as we decide to sell some assets where we've enhanced the value from the point of purchase.
Yeah, no, that would make sense. So with the office sector, it's interesting to hear what you said there. So that is obviously we've seen what's happened at regional REITs, and obviously sentiment towards the office sector. Where do you see returns coming from in that sector now?
Well, I mean, people think that people are less keen to go to the office, but I think that sort of idea is slightly frazzling out. I think offices are people are realizing the importance of offices, and I think it's a big opportunity because, as I said earlier on, a lot of investors are just selling out of offices because they kind of have to. And I know that there are investors who would not even touch an office investment with a barge pole, even if it was a great opportunity. I think there are some really exciting opportunities out there in good cities like Bath and Bristol, which are well-let properties with good ESG credentials, without capex having to be spent. And they will be like high yielding because the sector people just don't fancy it at the moment. So I think offices are becoming very much like best in class. So, the ones that are well located in the good cities, well let, I think investors shouldn't be nervous about. And I think that's very much how we feel about it. But I think the days of investing in kind of out of town office parks, I'm sort of quite nervous about that. I think the problem that you have with those types of assets is that you've got high refurb costs, and also tenants aren't prepared to commit to longer lease terms. So you'll be doing lots of lettings which are on like 3-year terms or 5s with 3-year breaks, and there'll be little rental growth, despite there being quite a lot of tenant churn, and as I say, like quite a lot of capex. But I think a good, well-located office in Manchester or a Bristol, well let, and with a modern specification, is very attractive, especially off the prices that are currently out there.
Yeah, cool. Okay, we've got a couple of asset-specific questions actually, so we'll run through those. So you recently sold the Price Busters building because of some unfavourable factors. what are signs you look for that indicate that the time was right to sell that property?
Well, on that property, it was quite a small lot size, and we have decided to sell out of some smaller lot sizes recently. As I said, like asset management really is kind of like the beating heart of what we do. So therefore, I can see why someone said, "Well, why wouldn't you asset manage this one?" But we had Sports Direct vacating in April, and we had a significant amount of vacancy in the upper parts. And it meant that the running yield was basically falling to negative once empty rates kicked in. And we could have probably sort of rolled up our sleeves and gone after, and the next asset management initiative, which would have been trying to do something with the upper parts. It would have been very capital intensive. It would have had an impact on obviously income. And I'm going to be, very candid. We just didn't really have the appetite for that on an asset of such a small lot size. So it was one that we decided to sort of weed out of the portfolio and, focus capital we have in the bank on other asset management initiatives in larger assets, which we're going to essentially add more value.
Yeah, that makes sense. Cool. So on dividend cover, when do you expect dividends to be covered by earnings? So you've got sort of money to spend. Do you think that will be once you've sort of deployed that money, will be up to sort of dividend cover?
Well, I'm not really prepared to sort of provide sort of a forecast, but I think that chart that I showed earlier on, shows that like we have consistently been moving in the right direction, and we have alluded into in our recent NAV announcement that there's a lot of exciting asset management going on in the portfolio, which will obviously add additional income. There is obviously the gap between our initial yield of 7.9% and our reversion of 8.8%. So, the asset management, the reversion in the portfolio shows that the earnings hopefully will be moving in the right direction back to the 2p. I think it's also worth noting that we are sort of at the bottom of a cycle, a property cycle. So there are some very exciting buying opportunities out there. And there has been a bit of a churn of properties within the portfolio over the last couple of years. That theme will continue, and we will hopefully buy some good assets which are high yielding, which will help contribute to that earnings growth going forward.
I know you pay one of the highest dividends amongst your peers, but this question here, is there further scope for dividend increases due to the rental reversion?
The dividend is obviously at the discretion of our board rather than us as the investment manager. But that has been the dividends that we sort of set our stall out when we IPO'd. And as I say, it is reviewed by the board on a quarterly basis. So that, yeah.
Yeah, that's fair. Sorry, I didn't miss a question here on your portfolio. So a lot of the question here says a lot of your portfolio property looks in need of modernisation. Are there plans to invest in upgrading this or disposing of
them? I think on that, like if we touch on, for example, some of our industrial properties, I get it. Like we say we don't buy like prime logistics, for example. We would buy well-located secondary industrial units. Now, a lot of these units could be, on the face of it, do look a little bit tired around and a bit rough around the edges. However, they do represent, importance to like the UK economy and like occupiers in general. And like if I take an example of like a property we have at Wake, for example, tenants there are paying like £4 a square foot. They've got 20-ton cranes and it's their old manufacturing units. And if those tenants were to vacate, they would be faced sort of at moving into like purpose-built modern accommodation and paying rents as high as like £7 a square foot, and they wouldn't get the craneage. So a lot of our industrial assets really do serve a purpose. There are a lot of good businesses out there doing providing important functions to the UK economy, and they do just want like cheaper space. I think it's probably also important to, we say that we have a low capital value per square foot. If you compare, the investment values of a lot of our industrial assets in comparison to what actually would cost to build them, and the site values, then we're very nicely positioned. I.e., we will have investments which are throwing off like yields kind of 8 or so percent. That actually, if you were to flatten those investments, they would have a higher site value for redevelopment. Naturally, that we do invest money in our properties. There's an industrial asset we have in Runcorn where we have 2 vacant units at the moment, and we're carrying out a sort of £1 million capex project on that property. Looking to move rents on from sort of like mid-5s to like £8 a square foot. So we do carry out refurbishment projects, but obviously they do have, they can have a bit of a strain on the company, but we are, as I say, property people, so we will obviously go after exciting property deals, and don't mind spending money, but it's not really a value add strategy, so therefore there are less refurbishments going on.
Yeah. Cool. Okay, so are you seeing valuation stabilising now across sectors, and if so, what sectors do you think will stage the biggest recovery as we come out?
Well, our June valuation was up 2.41%, and our March was up as well 0.41%. So, that's quite strong valuation performance relative to what we're seeing out there. But my sort of feeling is that we're sort of at the bottom of the cycle. There are some green shoots, but whether how long sort of we will stay at the bottom, I'm not sure. I'm not necessarily sure. But in terms of our existing portfolio, given that there's a lot of asset management ongoing in it, that's why we're seeing our valuations perform like they have, because we are adding value through asset management. I think in terms of like where we see valuations go, it's inevitable that when we do see a cut to interest rates, that values will probably start to move in the right direction again. But it's probably important to sort of emphasize for our portfolio, it's more kind of like asset management and what we're doing, which is contributing to valuation moves, rather than us sort of boarding a train and sort of the movements basically being sector or sort of UK-wide property movements, if that makes sense.
Yeah. Cool. Has the board considered doing buybacks, seeing that's a sort of 15% discount now?
My thoughts on buybacks are like, you'd be using sort of existing capital to obviously buy your own shares. Now, I get it, like that obviously shows conviction in your strategy and what you're doing. But when there are exciting asset management initiatives within the existing portfolio and really good buying opportunities, I would rather be spending that money on those asset management projects and new acquisitions than buying our own shares.
Yeah, no, I get that. Cool. Now, you obviously want to grow the size of the company. Sort of 175 million NAV, wasn't it? How do you think you can go about doing that?
Well, obviously the sector's had a bit of a rough time recently, and raising new capital when your shares are trading at a discount is obviously difficult for obvious reasons. There's been a lot of M&A and corporate noise within the sector, and we would always have our eyes peeled for potential opportunities. Albeit, obviously, we need to make sure that whatever we look at is in the best interest of our shareholders. Naturally, we would love to grow and we have our eye on that at all times. But I think it's also important to focus on the existing portfolio and continue the performance that we have seen over the past 10 years. When our shares are hopefully trading at a premium, which we would hope will happen again, we would obviously look to get on the front foot and try and grow the size of the company through raising new equity, whilst at the same time, as I say, having an eye on what's going on out there in terms of corporate opportunities.
Yeah, that's been a big sort of theme, hasn't it? Over the last, well, probably 2 years now, but it's really sort of heightened this year.
Very much so.
Yeah. So, and a lot in your peer group as well. So the diversified sort of REITs, a lot of the big ones have gone or are going. Where does that leave sort of the diversified REIT sort of sector, do you think? A lot of sort of smaller players.
Well, yeah, I mean, there's been this like the significant sort of weight of money has been raised in the REIT sector into the specialist sectors,
Yeah.
rather than a diversified. But we don't like to think of ourselves really as being diversified. I appreciate that we do hold properties across all sectors, so therefore we are diversified. But we like to say we do think of ourselves as being a specialist REIT because we're a high income REIT paying out that high dividend, so that is a speciality. That's why people typically buy us. And we're a specialist because we are value investors and we add value through asset management. If you take like LXI, for example, they will be thought of as a specialist REIT because they buy longer income and
Yeah.
it's RPI linked, but it's diversified because it's across all sectors, but they're not lumped in as a diversified REIT. So, they are long income and inflation linked. We are short income and typically open market linked. So we like to think of ourselves as being a specialist REIT.
Yeah. Yeah, that's cool. Just trying to. So with the new Labour government, is it sort of business as usual, do you think? Do you think that will have any impact? Good question on that.
I mean, the most obvious thing to sort of talk about really in terms of the Labour government, obviously it's very early days, but there's been a lot of noise on housing and relaxing of like the planning laws. And there's been this recent news about a sort of a grey belt, so to speak, where they're supposedly going to promote the redevelopment of brownfield sites. Now, that would potentially mean that, for example, kind of like out of town, peripheral industrial estates, for example, could be taken towards a residential use. I'm not a massive fan of that. I think kind of building on our green belts is not a great thing. I would rather sort of work with existing buildings in town centres. The previous government did relax the permitted development right rules, allowing buildings to be converted from office use to residential. And there was obviously a lot of buildings were converted 5 or so years ago. And then what's came in as Article 4s, which have restricted that. I mean, I would like to see sort of existing buildings in town centres be rejuvenated and converted into alternative uses, namely being residential, because obviously that is the sort of the big theme of providing, increasing housing in the UK. And that really does sort of touch on kind of what we are trying to do at like AEW UK REIT. So, we bought a Next in Bromley a year ago, and actually that has the ability, if Next were to vacate and if we decided not to let it to another tenant, which I think is highly unlikely, because Next are trading their socks off of there, but we could potentially convert that to 40 apartments. We have an office building in Gloucester where we've got permitted development consent to convert that into residential. So my hope is that that is what the Labour government will promote, the conversion of existing buildings into residential rather than new builds in our countrysides.
Yeah, nice. That would make sense. Yeah, cool. I think we've got minute or two, so maybe one last question. One here on do you own shares in the company? How many shares does management and directors own?
So the a number of people at AEW. I think it's important to mention. Obviously, AEW are the investment manager. We have like an in-house investment team, in-house asset management team. We run other portfolios. So people at AEW do own the shares, and our board of directors do as well. Yeah.
Yeah, cool. All right. Well, yeah, I think I rounded it up nicely. Really interesting proposition. So it's great to hear from you, and we'll see how it goes over the next sort of year or so.
Thank you, Richard. Thank you,
Thanks a lot.
James. Thank you, everyone, for joining.
Thanks a lot. Right. So that just leaves me with the legal bit there, which you can sort of read back on playback if you need to, and then what we have lined up over the next few weeks. So as you can see there, we've got Peter Hewitt in next week from CT Managed Portfolio. And then something I just wanted to flag up for the 20th of September is our next quarterly panel show, which is going to be on the new government, new outlook. So that should be interesting. We hope to see you then for that and next week as well. Have a great weekend.